Hello, everyone. Welcome back to How to Trade. I'm Shane Vernier, and this is FOMC Live. I can tell you right now, if you've never seen a hawkish rate cut, if you've ever seen a hawkish rate cut, you saw one today. We've been going on and on and on. I've been harping on and on and on about it. I definitely think that we're in a situation here where we could definitely be in for a major market correction in 2025. There's no question about it that we're already having political fights. We're looking at Jay Powell against Donald Trump after January 20th. That is going to happen. Now, what we saw out of the United States Federal Reserve today was a rate cut, a quarter-point rate cut, and then we saw this headline. And this is a headline that I've been talking a lot about right here. What do you got? S&P 500 gives up gains as Fed signals fewer rate cuts next year. Now, that's absolutely huge because when we talk about fewer rate cuts, what does that mean? It means higher for longer. And if we're higher for longer, that's not necessarily going to be a good thing for risk assets, and that is not a good thing at all compared to what we just saw come across the board. Now, full disclosure, we had some trades that we outlined earlier today. One of the things that I really harped on, and I went on and on and on about it, was precious metals. Be very, very careful with precious metals. We talked a lot about that, and I have to tell you that it's carnage out there right now for the gold market, but specifically for the silver market. I hope you didn't get caught long because this kind of headline right here is absolutely a killer. This suggests that you're going to be in for a stronger dollar, and you're not going to get those rate cuts next year. What does a stronger dollar mean to commodities? It means they're going to come down, and they're not just going to come down a little bit. They're going to come down a lot. Absolutely a huge, absolute blockbuster event. So good to see everybody. Ravi, good to see you. Ravi, let me see Sujit. Good to see you, Sujit. I'm back for your video. Welcome. You picked a great day because, I mean, this is a heck of a move. This is the look at our gold markets. We were trading gold futures earlier today at the 10-minute strategy blitz. Big time washout, really a big time washout right down there to 26.32. But I want to focus on the spot market because that's what most of you guys do. You trade spot. This is just an absolute devastating 30-minute bar, and it was negative 0.5%. Negative 0.5% in 30 minutes. That's absolutely a major move. So when I'm watching something like this develop, I'm going, geez, what is there any way out of it? Can we get out of it? Is there any way to get out of these longs? If you're holding longs on gold, you're in big trouble. I really harped on and on and on about exactly what we need to do to trade this successfully. And one of the things that I really mentioned, I said, listen, if you're long gold, be very careful beneath last week's low, but also last month's low. We got to watch November's lows very closely. 62% level, about 26.0891. That's a fantastic long. That's one that we're going to have locked and loaded here as we roll into Jay Powell's presser, which is coming our way in about T-minus 8 minutes. We're going to have to do a sound check before we get into Jay Powell's press conference, but definitely want to take a look at some of our interest rate expectations moving forward and also a few other things that I believe are going to develop for us here in relatively short order. The other warning that I gave, and I don't like to be ominous, but first things first, I'm a realist. Take a look at this. Weekly chart, I talked about silver a lot. I said, listen, if you're going to be trading silver, you've got to watch it. You've got to be very careful. And the reason why is if you're holding longs and you're ready to, you say, okay, well, I'm holding long silver. I don't disagree with you, but there's a key level that you have to look at. And if you ignore this level, you're more than likely going to get taken to the cleaner. So let's go ahead, pull up that monthly. This is the biggest level in the silver market right now, right there. Last month's low is at 29.64. If you see a break beneath that zone, get out of the way. If you're holding longs, fine. Your stop out point has to be beneath last month's low. It has to be, because if that in fact does sell off, that tells us two things. Number one, we're going to 78%. 28.30 is a far superior buy, and then we'll have an opportunity maybe to get long with a little bit better trade location. I want to be very careful with what we're doing here with the silver market. If you're long, I'm not going to tell you to sell. But I'm going to give you a little bit of safe conduct. If price breaks beneath that zone, get the hell out. Because that speaks to higher interest rates, bringing commodity prices down. It also speaks to maybe tariffs. We don't know what's going to happen with tariffs. We also are expecting sort of an economic boom here. I don't think we get it, not for at least a year or 18 months, but we're looking at a very serious situation with silver. I am ringing the warning bells. I don't do it often, but just get out. So I'm way behind on the live chats. Good to see everybody. Let me see Christopher. Good to see you. Christopher, Dave Thinking Systems. Good to see you. Dave 40. Good to see you. Dave Universal. Hey, yeah, gold absolutely smoked out. We talked about gold breaking beneath those key levels on the futures markets. That's exactly what happened. We saw a major washout in the gold market and futures. If you were short, you made a lot of money. If you were short that Euro USD, we talked a lot about that trade earlier today, breaking beneath yesterday's range. You wanted to play rotation until we got the big look at what Powell's going to say, and then we played the drop. So it was a pretty good trading day. We'll go over the numbers tomorrow. I don't want to get caught up in the tick scalping that we did earlier today, but good stuff. Absolutely. So, yeah, universal gold absolutely plunged. Let me see, Daniel. Rates down and the currency's up. Currency up. Only the USD can do that. USD is 0.65%. DXY is up a 0.65%. We did have a trade idea. But in any case, right here, Fed announcements is the name of the game. If you need anywhere to trade, be sure to check out Switch Markets. That's going to be exactly where you want to take, if you're in an international venue. If you're in the United States, we also work with Awanda, but we work with our partner broker, Switch Markets. They'll get you up and running, trading everything. Jeanette, good to see you, Jeanette. Welcome from down under. That's early. It's got to be early down in Australia. Real early. In any case, trade follow-up. We talked about the U.S. 100 yesterday. This was a good look at our U.S. 500. I'm going to look at that 5-8-13 trading strategy right there. Maybe, just maybe, on a 5-minute chart, we'll get an opportunity to bid this thing here in just a second. But we had a sort of a bid really outlined here for the U.S. 100, and I want to go ahead and get into it. This is our U.S. 500 triple moving average, 5-8-13. I'm going to cover that in a second. We've also got the Great Britain pound USD. Absolutely just fell out of bed by about 0.5%, 62% on our golden zone. Looked mighty nice. That looked mighty nice. So if you were short from up there, absolutely great work. We talked about it. We really wanted to short 127.50s. We just didn't quite get it. So that's kind of life there. Let's go to our US 100, sort of our weekly trade, or our daily trade idea, excuse me. And there it is. There's your trade idea right there with a bullish trend. There's our spike low. There's our spike high. There was the pullback right to 21,818, and right now we're at 21,840. Really a beautiful scalp. Let's take a look at what it took staying power-wise to be active in this market and have an opportunity. You really got a pretty good look at a nice scalp right away. 1206, we came right down. So 206 my time, big time rally, big time plunge. We took out this zone, but not by much, and we bounced up to about 46. That's a great scalp. If you've got the staying power to take a trade like that, there's your hesitation. All we're looking for at those support levels are a little bit of a rub. That's a beautiful trade. So definitely want to keep a look on that. We're still in the market if we are. In fact, trading, let's see, how high have we gotten yet? According to the trading signal, went up there about 21,848, and I believe our magic number is 21,875. So we're going to keep a close eye on this. It will not surprise me to see everything sort of slingshot back when Jay Powell starts speaking. But I will say, this is hawkish. This is hawkish. There's no two ways about that. Let me see. Sujit, the best swing trading strategy and the best scalping strategy. Check out our YouTube channel. That'll really get you up and running with a lot of different strategies across a lot of different things. Arshad, good to see you, Arshad. Welcome. Okay, let's go ahead and we had a request for the dollar yen, and then we got to do a few sound tests to make sure that I've got everything dialed up correctly. To be honest with you, trading and flipping all these switches can be really tough, especially when you're not a tech guy like me. I'm not tech savvy at all. I know how to trade. That's about all I know how to do. In any case, let's take a good look at what we have here. Monthly, of course, our monthly's up. The dollar yen's going to explode to the top side, especially if we're looking at a real hawkish dollar, which we've been calling on these streams for a long time, sort of been yelling it. Feeling from a mountaintop. This is a big month. I expect us to challenge all-time highs, especially next year in 2025. The first couple times that Jay Powell and the Fed decide that they're not going to go ahead and cut interest rates, they'll do that beginning in January. There's going to be a really good fight going. There really is. So right now, bullish price action. You can see there's your jump. How do you want to trade it? For me, relatively straightforward. Bang. Bang, something like that. Right here, this would probably be a real high-impact trade. If you wanted to take it, you could probably bid right here and expect 154.25 to hold up. Just be very, very cautious because Jay is going to talk here. Jerome Powell is going to talk here in about another minute, and we've got to be ready because he will shake these markets up. So what we're going to do is we're going to focus on, let's see, we want to save and close. We want to focus on a couple of different things here. Yeah, we probably should connect. Looks like we got disconnected from our trading feed. Let's go ahead and see what we can do here. Get all lined up with a little bit of paper trading so we can demonstrate some of these trades in real time. We did a lot of that earlier today. Okay, let's go ahead and see if I can get this going with our Jay Powell. There's going to be our... There's the balloon there. Let's go ahead and see if I can get the sound going. So I'm going to have to go ahead and ask you guys to give me a thumbs up when, in fact, let's see, when, in fact, we get a little sound. It should be some elevator music. If you can go ahead and give me a thumbs up. Oh, it's nice. Nice soundtrack. I've got it here. Just a quick thumbs up in any live chat, YouTube, Twitch, in the trading room, whatever you want to do. I think we should be good to go. Buy all the USD pullbacks and sell the USD. Well, I mean, it really does look like that. Bobby Bob, good to see you. We should be ready to roll with our sound. I don't have a thumbs up from anybody yet. Can you guys? Now you shouldn't hear anything, but there was some elevator music. All right, David, thank you. Appreciate it. Wizard Alvin, good day. Just made some from you. absolutely. Fantastic. All right, thanks, Dave. Thank you, system. There's a bit of a lag. Yeah, it was elevator music. All right, Jay Powell is the guest of honor. Look at that right there, dollar yen, 5 minute, beautiful, absolutely beautiful. That's what we're looking for, guys. Don't get into trouble playing backing the yen right now against the dollar. Extremely hawkish, even though we got a rate cut today. All right, here's Jay. What color? Thank you. What color tie does he have? Purple. He's acting like he's apolitical. He's not. He's a political machine. All right, here we go.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has moved much closer to our 2% longer run goal. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. To that end, today, the Federal Open Market Committee decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments.
Hey, Bobby.
Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of about 2% over the next few years. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 173,000 per month over the past 3 months. The unemployment rate is higher than it was a year ago, but at 4.2% in November, it has remained low. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than in 2019.
All good here.
The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.2% at the end of this year and 4.3% over the next few years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in November, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.4% this year and 2.5% next year, somewhat higher than projected in September. Thereafter, the median projection falls to our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 4.25% to 4.5%. We've been moving policy toward a more neutral setting in order to maintain the strength of the economy and the labor market while enabling further progress on inflation. With today's action, we have lowered our policy rate by a full percentage point from its peak, and our policy stance is now significantly less restrictive.
Oh.
We can therefore be more cautious as we consider further adjustments to our policy rate. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate,
I'm telling you.
the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of next year,
They're not
and 3.4% at the end of 2026.
They're not cutting.
These median projections are somewhat higher than in September, consistent with the firmer inflation projection. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can ease policy more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. On a technical note, we lowered the offering rate on our overnight reverse repo facility to align it with the bottom of the target range for the federal funds rate, its typical configuration. Technical adjustments of this kind have no bearing on the stance of monetary policy. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to
everything we do it for you. We're working a 1 minute US 500 crossover, 5-8-13.
Thank you for taking
We're
our
waiting for that
questions.
rally. The bottom's falling out of the
I
NASDAQ.
wonder if you could talk a little bit about why
Let's go ahead and listen
officials
to
think it's appropriate to cut rates at all in 2025 if inflation is expected to remain firm throughout the year. And what would you expect at this point the timing might look like? Would a January cut potentially be possible, or does a pause next month seem more likely?
There's our bid right there in gold,
Well,
right around
so let me
2609.
start by
Love
saying
it.
why we cut today and then move to 2025. So I would say today was
This is a
a
trend.
closer call, but we decided it was the right call because we thought it was the best decision to foster achievement of both of our goals: maximum employment and price stability.
Absolutely,
we see the risks
Ben.
as two-sided, moving too
That sums it
slowly
up.
and needlessly undermine economic activity in the labor market,
Here we
or
go.
move too quickly and needlessly undermine our progress on inflation. So we're trying to steer between those two risks. And on balance, we decided to go ahead with a further cut, and I'll give you some details on why. Downside risks to the labor market do appear to have diminished, but the labor market is now looser than pre-pandemic, and it's clearly still cooling further, so far in a gradual and orderly way. We don't think we need further cooling in the labor market to get inflation down to 2%. Job creation is now well below the level, or certainly below the level, that would hold unemployment constant. The job finding rate is low and declining, and other measures such as surveys of workers and businesses, quits, things like that, broadly show a much cooler labor market than we had in 2019. It's still quite gradually cooling. So we keep an eye on that. Inflation, we see that story as still broadly on track, and I'll tell you why. We've made a great deal of progress. 12-month core inflation, as I mentioned, through November is estimated at 2.8%, down from a high of 5.6%.
Yeah, but go to the grocery store. No one cares.
Inflation has actually been moving sideways as we are lapping the very low readings of late last year.
Right,
Housing services inflation actually is steadily coming down now, albeit at a slower pace than we might like, but it has now come down substantially, and it is making progress slower than hoped. And we've had recent high readings from non-market services and some bumpiness for goods. So I'll just say, so remember that we coupled this decision today with the extent and timing language in the post-meeting statement that signals that we are at or near a point at which it will be appropriate to slow the pace of further adjustments. You ask about 2025. I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation that inflation will be higher. You saw in the SEP that risks and uncertainty around inflation we see as higher. Nonetheless, we see ourselves as still on track to continue to cut. I think the actual cuts that we make next year will not be because of anything we wrote down today. We're going to react to data. That's just a general sense of what the committee thinks is likely to be appropriate.
Sorry, just one quick follow-up. Why, I guess, would you make those cuts? Like, what would be the trigger to cut?
So we're to cut further after this point. I would say it this way: we've reduced our policy rate now by 100 basis points. We're significantly closer to neutral.
Yeah, absolutely.
At 4.3% and change, we believe policy is still meaningfully restrictive. But as for additional cuts, we're going to be looking for further progress on inflation, as well as continued strength in the labor market. And as long as the economy and the labor market are solid, we can be cautious about as we consider further cuts. And all of that is reflected, to your question, in the December SEP, which shows a median forecast of down 2 cuts next year compared to 4 in September.
Martin, the NFP numbers didn't match his stats. Yeah, there's always variance in there, isn't there?
So this does seem similar to the dynamic in
We just threw a bunch of
2016
numbers
during the
at us.
last transition to a Trump administration, where the committee saw slightly tighter policy, in part in expected anticipation of the fiscal policy stance that was seen evolving over the year. Some of it was a data mark-to-market exercise, and some of it was anticipation of fiscal. What's the split on this one? How much of this was accounting for inflation data that was coming in, and how much of it is expecting that there will be inflationary fiscal policy next year?
I'd say I'd point to 5 or 6 things, and let me start by saying that we think the economy is in a really good place, and we think policy is in a really good place. Let's remember that the economy is growing 2.5% this year, that inflation has come down by 50% from 5.6% to 2.6%. Headline inflation is 2.5% on a 12-month basis. We're actually in a really good starting place
Those are
here.
still growth
But
numbers,
since,
though.
So what's really
Inflation's
driving
still growing.
the slower
Jay,
rate cut
don't
path?
try to
First thing is
fool us.
growth is stronger, right? The economy grew faster in the second half of 2024 so far than we had expected, and is expected to be above what our expectations in September next year as well. Unemployment is lower, and in the SEP you'll see that participants think that the downside risks are less and uncertainty is less. So that's more strength, right? Inflation is higher, as we talked about. Inflation's higher this year. It's also higher in the forecast next year. I'd also point out that we're closer to the neutral rate, which is another reason to be cautious about further moves. But then getting to your point, there's also there's uncertainty. Uncertainty around inflation, I pointed out, is actually higher. It's also in the case of some people, the way I would say it is this: some people did take a very preliminary step and start to incorporate highly conditional estimates of economic effects of policies into their forecasts at this meeting, and said so in the meeting. Some people said they didn't do so, and some people didn't say whether they did or not. So we have people making a bunch of different approaches to that. But some did identify policy uncertainty as one of the reasons for their writing down more uncertainty around inflation. And, you know, the point about uncertainty is it's kind of common sense thinking that when the path is uncertain, you go a little bit slower. It's not unlike driving on a foggy night or walking into a dark room full of furniture. You just slow down, and so that may have affected some of the people. But as I said, there's a range of approaches on the committee.
If I could follow up on that, you mentioned the risk and uncertainty indexes toward the back of the document. The upside risk to inflation jumped quite substantially. The only thing really that's happened, you mentioned that the disinflationary story remains intact, yet the risk weighting has jumped to the upside. The only real thing that's happened is November 5th in the meantime. Is it fair to say that that's what's driving the higher sense of upside risk on inflation?
Actually, that's not the only thing that's happened. What's happened is that our forecasts for inflation for this year, I think, are 0.5 higher than they were in September. So you had 2 months of higher inflation, September and October. As I mentioned, November is
So why are you cutting
track,
interest
but, you know,
rates if you've got
once
consistently
again,
high inflation? What you do
we've
makes
had
no
a
sense,
year-end projection
Jay. It makes no
for
sense.
inflation, and it's kind of fallen apart as we've approached the end of the year. So
Why are you cutting rates?
That is certainly a large factor in people's
Doesn't
thinking.
make any
I can tell you
sense.
that might be the single biggest factor is inflation has once again underperformed relative to expectations. It's still, you know, going to be between 2.5 and 3. It's way below where it was, but you know, we really want to see
It's entrenched, and you
progress
know
on
it.
inflation. To you know, as I mentioned, as we think about further cuts, we're going to be looking for progress on inflation. We have been moving sideways on 12-month inflation as the 12-month window moves. That's in part because inflation was very, very low measured in the fourth quarter of 2023. Nonetheless, as we go forward, we're going to want to be seeing further progress on bringing inflation down and keeping a solid labor market.
This is Euro FX futures. If you're a futures trader, we're looking to sell any pullbacks we can really
Chris
get.
Rugaber at Associated Press. Thanks for
May
taking the
even go down
question.
to a 1 minute.
In September 2018, the Fed staff in the Teal Book discussed a policy of looking through any new tariffs as long as there were one-time increases and inflation expectations remained anchored. Could you comment on if that analysis remains
Wow, they're cutting rates again in
effective
Sweden,
and
Calvin.
any other thinking
Unbelievable.
on tariffs generally that you can share?
It's
So
irresponsible.
I do think
It really
that
is.
2018, the September
And they know that.
2018
He knows that.
Teal Book alternative simulations are a good place to start. I happen to have brought them here with me today.
Talking about
I'm sure
2018
you
because
got
they had a
them
big
too.
Christmas crash.
They're a good starting
Christmas
point.
Eve.
And
I was
and
there.
I
It
would
was
just
brutal.
say, you know, it's 6 years old analysis, but nonetheless, this is still, I think, the right questions to ask. And you know, there were two simulations. One was seeing through, one was not. And I'd point you. There's some language in the see-through
if we can get a 1
paragraph
minute
that
short
says,
here on the Euro
you know,
FX.
that considers situations in which it might be appropriate to see through inflation, and then name some conditions that in which it might not be. In any case, this is not a question that's in front of us right now. We won't face that question. We don't know when we'll face that question. What the committee's doing now is discussing pathways and understanding, again, the ways in which tariff-driven inflation can affect tariffs can affect inflation.
Yeah, I
in the
mean, we're
economy
already
and
blaming policy
and how to think
for the
about that. So
inflation. This is
we've done
ridiculous.
a good bit of work. All of us have. Each of us has, and you know, it puts us in position when we finally do see what the actual policies are to make you know, a more careful, thoughtful assessment of what might be the appropriate policy response.
Boy, this euro's
Great.
gone.
And just a quick follow. Given the recent bout of inflation that we've been through, with consumers seeing how, you know, prices can rise and businesses seeing that they can raise prices at least for some time, does that make it a little bit riskier to look through tariffs? I mean, do you feel you have to respond more quickly to inflation threats, given
Markets are
what we've seen
tanking
in the
right
past
now.
few years?
So
Thank
the
you.
main thing is, and this is also a point in these alternative simulations, is there are just many factors that go into
Definitely an oversold
how much
territory. We're gonna see if we can
tariffs
get a
will
buy out of
even
this.
Go into
5.813.
consumer inflation.
It's gonna be
How
hard.
persistent will that be?
All right, we're long
you know,
here.
so we just
gotta be
don't
long.
know really
Do we get
very
filled?
much at all about the actual policies. So it's very premature to try to make any kind of
Oh, I
conclusion.
mean,
we
welcome
don't know
to
what will
welcome
be
to active
tariffed from what
trading. We're sitting there
countries,
26.10.
for how
I don't get
long,
filled.
in what size. We don't know whether there'll be
Fill me
you
up.
know, retaliatory tariffs. We don't know what the transmission of any of that will be into consumer prices. To your point as well, I wouldn't say that we know whether the last episode is
impressed.
or is not a good model for what happened. You pointed out we've just been through a period of high inflation. We've just gotten through that period. That's a difference. There was also quite
Yeah,
a
it's
bit
all
of
about the dollar
diversion
today.
of trade away from China to other countries since that may have effects. I don't know. I just think we need to take our time, not rush, and make a very careful assessment.
guess
But only
these are
when
worth
we've
a little
actually
bit more
seen
now?
what the policies are and how they're implemented. And
I'll go
we're
to the
just
store,
not
won't be
at
able to
that
buy
stage. We're at the
anything
stage
again.
of doing what
$100
other
every time I
forecasters
go.
are doing, which is kind of thinking about these questions, but not trying to get to definitive answers for some time.
Let's see if we get filled up this time down.
Nick Timmeros of the Wall Street Journal. Chair Powell, to make sure I
Nick.
understand, participants today revised up their core PCE inflation projection for 25 so that the central tendency runs from 2.5% to 2.7%.
Well, that was our trade
Most
right
of the
there.
committee
Bang,
sees the
bang.
risks to those projections to the upside. So if inflation only declines next year from 2.8 to 2.5 to 2.7, what would compel the committee to be cutting in that situation?
Let me find these numbers.
Way to come prepared for class.
So we have
Come on, Jay. You got one job. Yeah, Calvin, the dollar's ruling the roost right now, 108. I mean,
inflation
this
coming
is
down. Core
we're
inflation
getting
coming
back
down
to
to
really
2.5
high
next
dollar
year.
valuations. It's going to kill everything.
That'd be significant progress. It's going to start a slower path. I think
All right,
that
we're
does
long.
take on board that we want to see real progress, but we'd be seeing
Let's see
meaningful
what happens
progress to
there.
get inflation down to that level. That wouldn't be all the way to 2%,
Swiss
but that
francs.
would be
No, those are
better than
dollars.
this year.
I wish
This
they
year
were
will be
Swiss
2.8 or
francs.
2.9. That would be meaningful. We also have to think about the
We got to get a
the
nice
labor market.
retracement
And
off
while
of this
we have
10
the
level,
labor
at least
market
up to
forecast as
15.
being
Maybe this order block
in good
right up
shape, We
here.
are also
We're
mindful
going to let this
that
thing run
it is
for a little
still
while and see how
out
this
there
develops.
very
This is a
gradually
potential
cooling
bottom
so
of the gold
far in an
market today. It
orderly,
really is.
gradual
We'll see.
way.
We got to wait and see,
But it's
though.
also something we need to keep our eye on.
I guess
The
if I could
video,
follow up,
Abdul?
if somebody looked at these projections and also the insertion of the extent and timing language in the statement, which has been used at times in the past.
All right, here's our
when the
short right
committee
here on the
thinks
Euro
maybe it's going to be on
USD.
hold for a while, and they said, gee, this looks like it could be the
103.92.
last rate cut for
We're
some
going to par
time.
value here.
Would they be mistaken to
103.92.
infer that?
So that's not the
disorder.
that's not any decision
So,
that we made
limit.
at all. Let me explain extent and timing. So the sense of that wording is to make clear that if the economy
short
does evolve
89s.
about as anticipated, we're at a point at which it would be appropriate to
We
slow
wanna
the
get with
pace
it.
of rate cuts.
Pressure on
extent,
gold, though.
That just
No
relates
two
to
ways about
how
it.
much further we can reduce our policy rate consistent with getting to a neutral stance. Clearly, that distance has shrunk by 100 basis points, so it's significantly smaller. So that's the extent question. And we're going to be looking for further progress on inflation as well as a strong labor market to make those cuts. Timing
1.6
just
spread on
suggests,
the Euro
again, that
USD
we're at a
right now.
place
That's
where
big.
assuming the economy
Believe it.
develops as expected, we're at or near a level that will make it appropriate to slow the pace of adjustment. So that's what we mean by that.
GT, what
We're
about
not trying to
crypto?
make decisions
Good
about
question.
the longer run. We're trying to make sensible policy as we go. And, I just would emphasize the uncertainty, which is, it's just a function of the fact that we expect
Bitcoin.
significant policy changes. There's nothing really unusual about that. I think we need to see what they are and see what the effects they will have. We'll have a much clearer picture, I think, when that
Dollar's
happens.
killing everything right now. This is our support zone, right between 105 and 100. I was talking with a trader earlier
McKee
today.
from,
I
Bloomberg
don't really
Radio
know
and
how you could
television.
pass on buying 100s right now.
Even though you've
I would
cut
be right
rates
there,
by 100 basis
78%,
points this year,
101.
we haven't seen much
Pretty good
change
bid.
in mortgages, auto loan rates, or credit card rates. You say you're significantly restrictive. Are you running a risk that the markets are fighting
Right
against
there.
you?
This is
and
a big reset
the
right now,
economy
what's
could
happening.
be
We're resetting everything.
More at risk of a slowdown than you anticipate?
So the rates that you talked about are really longer run rates, and they are affected to some extent by Fed policy, but they're also affected by many other things. And longer rates have actually gone up quite a bit since September, as you well know, and those are the things that drive, for example, mortgage rates more than short-term rates do. So we look at that, but we look at all financial conditions, and then we look at what's happening in the economy. So what we see happening in the economy, again, is most forecasters have been calling for a slowdown in growth for a very long time, and it keeps not happening. So
It's
we
a
have
pretty good
we're now
opportunity here to
well
buy
into
crypto,
another
though.
year of growth that looks like it might be 2.5%. Second and
I'm
third
watching
quarters were
101.
right about at the same level. So
In
the U.S.
Bitcoin.
economy is just performing very, very well, substantially better than our global peer group. And
We're
there's
just
no
not
reason to
getting any
think
love
a
towards the
downturn
indices.
is any more likely than it usually is. So the outlook is pretty bright for our economy. We have to stay on task, though, and continue to have restrictive policies so that we can get inflation down to 2%. We're also going to be looking out for the labor market. We want to keep the labor market pretty close to where it is. We're pretty close to estimates of the natural rate of unemployment. Job creation is a little below the level that would keep it there, but nonetheless close. And so that's what our policy is trying to achieve.
If I could follow up by asking about your formulation for beginning rate cuts included the phrase, we need to have confidence that inflation is moving down towards
Good
our
question.
target. Given the fact that you've raised your forecast for next year, do you have confidence or are you uncertain about the path of inflation going forward?
So confidence was our test for raising rates, and we made, look at the broader sweep. We've made just a great deal of progress. We're well into the twos in core inflation, and around 2.5 or even lower than that we have been for headline inflation. So I would say I'm confident that inflation has come down a great deal, and I'm confident in the story about why it's come down and why that portends well. And I'll tell you why. Again, you do see with housing services inflation, which is one that we've really worried about, it really has come down now quite steadily at a slower pace than we thought 2 years ago, but it's nonetheless steadily coming down as market rents start to equilibrate better with
This thing's cratering.
New leases that turn over.
Heat on
Not
gold,
new
big
tenants,
time
but new
heat.
leases. Market rents is new leases. So that's happening. That process is ongoing pretty much as
Pretty
we
good
expect.
bounce.
Goods inflation,
13.
which is another big piece of it,
Now we're coming off a
has
little bit.
returned right to the range where it was
I don't
before the
know.
pandemic.
You gotta start thinking about
for some
bailing.
months this year, it kind of moved up in a bumpy way because of used
Give it a
cars
few
and things
minutes,
like
see
that.
what
But we
happens.
think overall that should
a good level,
generally
though.
be in the range it was in. That leaves non-housing services.
Absolutely, Abdul.
And market-based non-housing services are in good shape. It's non-market services, and those are services that are imputed rather than measured directly, and they don't. We think they don't really tell us much about the about tightness in the economy. They don't really reflect that. I mean, a good example is financial services, which is really done off of asset prices. And that's how that
going to
inflation works.
26.
So the
We'll wait and see
overall
what
picture,
happens here.
the story of why inflation should be coming down
Stop
is still
talking,
intact.
Jay.
In particular, the
You're
labor
killing the
market. Look at
market.
labor
Stop
market.
talking.
It is cooler by so many measures now, modestly cooler than it was in 2019,
Yeah, that
a
was our
year when
sell right
inflation
there.
was
Didn't get
well
it
under
again.
2%. So
Good
it's
Lord.
not a source of inflationary pressures. Not to say there aren't regional and
We're still
particular
sellers
professions
here.
where labor is tight. But overall, you're not getting inflationary impulses of any significance from the labor market. So what's the story? The story is still just we're unwinding from these large shocks that the economy got in 2021 and 22 in, for example, housing services, and now also in insurance in particular, where costs went up, and those are now being reflected later in housing insurance. It's real inflation, but it doesn't portend persistently high inflation. So we and most other forecasters still feel that we're on track to get down to 2%. It might take another year or two from here, but I'm confident that that's the path we're on. And
You've had
our
4 years
policy
to unwind
will
it
do everything
since
it can to
COVID.
assure that that is the case.
You've had 4 years to unwind what the mess you guys made with unlimited QE. 4 years, and now you're going to blame tariffs? Are you kidding me?
Thank you. Colby Smith with the Financial Times.
I very
the
rarely get
unemployment
upset
rate
at
as of
Jay,
November,
but
while
he's
still
killing
very
me
low,
today.
is
He's
within
killing me.
spitting distance of the level that generated a lot of concern about the labor market over the summer in the lead up to the 50 basis point cut in September. Hiring has also narrowed to just a handful of sectors. But now the committee appears comfortable skipping cuts at upcoming meetings. So what has changed about the committee's assessment of the risks confronting the labor market? Is there just less concern now on
the
that
political
front?
landscape
Or is it
changed.
just about there being more upside risk to inflation that now
what
needs to be
happened.
accounted for?
The unemployment rate is now the same as it was in July, 4.2%. It's moved up and down, but it's now the same as July.
Yearly range?
Job creation is lower than it has been,
Potential
but
sell there in the Swissy.
it's been steady. It's not declining. It's steady at a level which as I pointed out a couple of times, is actually below the level that would hold the unemployment rate constant, but it's not so far below. So you might, if we have the break-even level right, and if job creation continues at that level in the establishment survey, then you would get a tenth maybe every other month kind of thing. So gradually declining. We don't have that kind of precision in this. So but you're right, though, and I read out some of the reasons. We do think the labor market is still cooling by many measures, and we're watching that closely. It's not cooling in a quick or in a way that really raises concerns. I think, you pointed out, participants in the FOMC really thought that the risks and uncertainty had improved relative to the labor market, and it's because things have just gotten a little bit better. It doesn't, unemployment rate flat and things like that. Nonetheless, we're watching it closely.
If the idea, though, is that no additional kind of softening in the labor market is welcome here, what's to prevent that from happening if rates are still restrictive?
So what I said is we don't think we need further softening to get to 2%
I agree,
inflation.
Calvin. He needs to
That's what I'm
stop
saying.
talking right
Not that
now.
it's not welcome.
Stop talking.
We don't need it, we don't think. If you had a
He's
situation
cratering the
where
markets, guys.
inflation's
There's no
moving
two ways
around
about
by a
it. This
tenth
is as
every
bad
few
as I've
months,
seen it in a long
that's,
time.
We'd have to weigh that
Force
against
down 500
the
on the
fact that
Dow.
inflation has, in recent months, been moving sideways in the 12-month window. And so we've got to weigh them both.
We may get an
And at this
opportunity
point,
to buy.
For a while there, we were
I would
only
buy
really
when he stops
focused-
talking.
Mainly focused on
I'd be looking to buy the indices when he
We've
stops
now
talking.
gotten to a place where the risks to the two are, or we think, are roughly in balance.
A pretty good
And
pullback.
so that's how we think
Absolutely,
about it.
Daniel, and BTC.
Steve.
Mr. Chairman, I did not hear you use the word recalibration today. And I'm just wondering if the recalibration phase is over and what you might call this new phase and whether the criteria for changing rates is somehow different and higher than it was before. Thanks.
We're not renaming the phase yet, but we may get around to that. But no, I would say we are, though, in a new phase in the process, as I said. So,
All right, this is gonna
and
be our
that's just
trade, it
because
looks
we've
like, on the
reduced our
5.813.
policy rate by 100 basis points. We're significantly closer to
RSI,
neutral.
oversold.
We still
We're
think
looking to
where
buy.
we are is meaningfully
Buy when the
restrictive.
5 crosses the 8.
And I think from
and
this
price
point
is
forward,
above all 3.
It's
Those are the
appropriate to
conditions.
move cautiously and look for progress on inflation. We've done a lot to support
get it.
economic activity by cutting 100 basis points, and that's a good thing. I support the decision. And
Wizard
and I
Alvin,
think it was
bring in
right
the
decision to make.
drones.
I
You're
think from
absolutely
now,
right.
We are in a place where the risks really are in balance, and we need to see progress on inflation. And that's how we're thinking about it. So it is kind of a new thing. We moved pretty quickly to get to here, and I think going forward, obviously, we're going to be moving slower, which is consistent
What about
with
the UFOs?
with the SEP.
Ask him about the UFOs.
I wonder if I could follow up and ask you how much you or the committee are looking through some of the high numbers we've had in the recent inflation numbers. For example, cars being up maybe because of the hurricanes, eggs because of the avian flu, that kind of stuff, and then looking forward perhaps to housing inflation coming down as it did in the recent report.
So we always try to be careful about not throwing out the numbers we don't like. It's just an occupational hazard is to look, those high months are wrong. What about the low months? We have a very low month potentially in November. It's estimated by many to be in the mid-teens for core PCE. So that could be idiosyncratically low. We try to look at not just a couple or 3 months.
Not
We
just
shouldn't
low,
have- our position
idiosyncratically
shouldn't
low.
change based on 2 or
Oh,
3 months
Jay,
of
you
good or
crazy
bad
academic,
data.
you.
We have a long string now
The hell
of
does
inflation coming down
idiosyncratically low
gradually
mean?
over time.
I have no clue.
As I mentioned, 12-month, I think it's 12-month headlines 2.5, 12-month core is 2.8. That's way better than we were. We still
the
have some
damage
work
is
to
bad,
do, though,
Calvin.
is how we're looking at it,
Bad.
and we need policy to remain restrictive to get that work done, we think.
Neil.
Yeah, and the bottom it just keeps getting worse.
Thanks, Chair. Thank you, Chair Powell. Neil Irwin from Axios. Financial markets
Didn't
have been
get
very
that
buoyant
sell.
really all year. Is the committee comfortable with where financial conditions are, or do you see a risk that looseness in financial conditions could undermine progress on your inflation target?
So we do look carefully at financial conditions, of course.
That
That's part of
Swissie's
what we do.
attractive
But
right there to
what
the
we
short.
really look
QQQ.
carefully at is the performance of our
Did we fill our
goal
gap in?
variables and how are we affecting the economy. So what we've seen over the course of just take the last year, We've seen inflation, well, over the last couple of years, come down a lot. We've seen the labor market
Gaps
cool
get
off
filled,
quite
gaps
a
get
bit.
filled, gaps
That
get
suggests
filled,
that our
Dave.
policy is restrictive.
Right there.
We can
That was
also
our
look
gap.
more directly at
That's
the
where we're
parts of
going.
the economy that are affected by,
we get
that
there,
are interest
that's your
sensitive,
bid.
like particularly housing. Housing activity is very low, and that's partly significantly because of our policy. So we think our policy is working, it's transmitting, and it's having the effects on our goal variables that we would want.
That's the trade. You're trading the QQQ.
You know, a lot of things
That's the
move
bid.
financial conditions around, as you know, and we don't really control those. But I'd say we see the effects we're
This
hoping to
gold's
see
getting
on
slaughtered
the
right
goal
now.
variables and the places where we'd expect to see
Had a
it.
chance to get out
So
of
if I may,
break even
speaking
3
of,
minutes ago.
assets
Let's
that
let
have-
this
that
thing
have
roll.
been buoyant, do you see any value or benefit in the U.S. government building a reserve of Bitcoin?
So, you know, we're not allowed to own Bitcoin. The Federal Reserve Act says what we can own, and we're not looking for a law change. That's the kind of thing for Congress to consider, but we are not looking for a law change at the Fed.
Andrew.
Hey, happy holidays, Mr. Chairman. Thanks for taking our questions. I was wondering if you are satisfied with the way 2024 is ending, if you're confident that we've avoided the recession that forecasters were predicting as inevitable a couple years
Oh,
ago.
they're saving that.
I think it's pretty clear we've avoided a recession. I think growth this year has been solid. It really has. PDFP, private domestic final purchases,
5, 8, and
which we think
13
is
wizard.
the best indicator of private demand, is looking to come in around 3% this year. This is a really good number. Again, the U.S. economy has just been remarkable, and it's when in these international meetings that I attend, this has been the story, is that how well the U.S. is doing. And if you look around the world, there's just a lot of slow growth and continued struggle with inflation. I feel very good about where the economy is and the performance of the economy, and we want to keep that going.
The
All
other
right, here
thing
we
I just
go.
wanted to ask about was the, you guys have noted that the unemployment rate is still low. However, employment rates have fallen rather quickly. The prime age employment rate has fell by about half a percent rather recently. The question, I guess, is do you think there's maybe more downside momentum in the labor market than the unemployment rate alone is
Here we
signaling?
go.
I don't think so, no. I think overall, if you look at it, prime age participation is still very high.
Not yet.
What's going
Not
on
yet.
in the labor market is
You don't buy yet. We're not above
that
all
the
three.
hiring
It's got to be
rate
above
is
all
low.
three moving
So
averages.
If you have a
Right
job,
here, we're gonna
you're
get
doing
it.
very well, and layoffs are very low, right? So people are not losing their jobs in large numbers, unusually large numbers.
not
If you are
necessarily
looking for a
true.
job, though, the hiring rate is low, and
Depends
that's a
on your
signal
sector.
of lower demand. It has come down. So we look for signs like that, and that's clearly a sign of softening, further softening. I didn't mention it earlier, but I think you can see an ongoing gradual
Long on
softening in the labor
crypto?
market. Again, not something we need to see
Can't argue
to
with
get
you.
2% inflation. And, you know, that's part of the reason that explains why we moved ahead today with the action, with an additional cut. So, but you take a step back, the level of unemployment is very low. Again, participation is high. Wages are at a healthy and ever more sustainable level, wage growth. And so the labor market, this is a good labor market, and, you know, we want to keep it that way.
Thanks.
Amira.
That they are
Thank you,
crying
Amara
on
McCoy
Wall
from
Street
Bloomberg
for
News.
him
I
to
just
stop
want to put a
talking.
finer point on the labor market. Can you keep the labor market this way in the strong position that you have
New yearly highs in the
described
DXY?
without further cuts? In other
Wow.
words, do you still view the labor market as needing support to protect against a further cooling?
You know, we can't know that with any tremendous certainty. I will say that we think that our policy balances the risks. We think the risks are roughly in balance as between the two mandates. And we think the labor market is in solid shape. And when I say it's softening or cooling, it's a very gradual process. You know, job creations are meaningfully positive. Wages are, you know, if
Half of
anything,
them
a
are
little
government
still a
jobs,
bit
Jay, and
above
you know it.
what would be sustainable if productivity were
That's
to
gonna
revert to
change.
its longer run trend. If you take into account the high productivity readings we've had, then wages are already at a sustainable level relative to 2% inflation. So, I don't want to overstate the downside in the labor market, because the downsides clearly appear to have diminished. nonetheless, it's one of our mandate goals. And, we pay close attention to it, and it's worth noting that it is still gradually cooling, gradually and in an orderly way. And that's how I would characterize it, and that's why
That's a
we're
good one,
paying
Daniel.
careful attention.
Elizabeth.
Wow.
Thanks so much, Chair Powell. Elizabeth Schulze from ABC News. As you've noted, the Fed is now forecasting higher inflation next year. High prices are still a burden for so many households right now. Why do you think it is that inflation is proving to be more stubborn than you'd expected?
Because they never took care of it. He didn't want to raise interest rates.
It
You know
breaks
it
down
too,
into
Jay.
a
Just say it.
long answer if you want, but it just has been a little bit more stubborn. I think if you
It's
go
been
back
tough,
2 or 3
you know.
years, many people were saying that to get this far down, we would have had to have had a deep recession and high unemployment by now. Well, that has not been the case. So, the path down has actually been much better than many predicted.
It's
And
not
we've
down. I'll show you the
managed
numbers.
to have the unemployment
It's
rate
entrenched.
remain essentially
difference.
at
Big
its longer
difference.
run natural rate, while inflation has come down from, core PCE inflation has come down from 5.6% to 2.8% on a 12-month basis. So that's a pretty
The
good
CPI and
outcome.
PPI are still growing
Why hasn't it come
significantly
down?
month over
One
month.
reason is that just a technical issue around the way we calculate housing services.
Boy, this
And
is persistent, isn't it?
that
This thing's
process
just
has been
cratering.
slower than
Good Lord.
market rents are showing up more slowly in that measure than we might have thought 2 years ago. So that's part of it. I think there are other parts of the story, but what I think people are feeling right now is the effect of high prices, not high inflation. So we understand very well that prices went up by a great deal. And
That's the
people
pot and the
really
kettle,
feel
isn't
that,
it?
you know,
High
it's
prices
of
and high
food
inflation.
and transportation and heating your home.
High
and things
prices
like that.
are
So
high
There's
inflation.
tremendous pain in that burst of inflation that was very global. This was everywhere in all the advanced economies at the same time. So now we have inflation itself is way down, but people are still feeling high prices, and that is really what people are feeling. The best we can do for them, and that's who we work for, is to get inflation back down to its target and keep it there, so that people are earning, big real wage increases, so that their wages are going up. Their compensation is going up faster than inflation year upon year upon year, and that's what will restore people's good feeling about the economy. That's what it will take, and that's what we're aiming for.
And as we look ahead to next year, what do you see as the biggest challenge to the economy under the next administration?
I feel very good about where the economy is. Honestly, I'm very optimistic about the economy, and we're in a really good place. Our policy's in a really good place. I expect another good year next year.
Edward.
Wow, the length of this press conference is significant. They just keep letting him talk
Edward
and
Lawrence
bury
from
these
Fox
markets.
Business. So you say that we're closer to the neutral rate. What percent do you see and the committee believes, where is that neutral rate?
So
we're over
I'll say a
42
couple things.
minutes.
First of all, when we write, the thing we write down in the summary of economic projections is the longer run neutral rate, which is the neutral rate at a time when supply and demand are in balance, the full economy is in balance, and no shocks are hitting the economy. That is not where we are right now. So when we're making monetary policy at the Fed, that's not the question we're asking. So you can't do a straight read between those longer run numbers that we write down and what we think the appropriate policy should be. So basically, at any given
NASDAQ.
time, various shocks are hitting the economy.
Same
And so what we're
situation.
doing in real time is we're looking at our policy stance, and we're looking at the way it's hitting the economy, and particularly we look at the effects it's having as we try to move the economy toward maximum employment and price stability.
That's a
And
good
the
gap
answer
in the
can
triple
be,
Q.
there are things that affect the economy that are lasting but not permanent, and the ones that are permanent are the ones that would be in our star. The ones that could be lasting but nonetheless go away
Yeah, I
over
mean,
time,
that's solid
they
right
could
there.
actually affect what's sort of technically the appropriate neutral stance in near
take
term.
out 101.
So we're looking at that.
We're gonna go down and
you
have
know,
a peek
we
beneath
don't
the
know
100.
exactly where it is, but as I
gonna
like to
wash
say,
out
we
a
know
lot
it
of
by its
retail
works.
longs.
And I think what we know for sure is that we're 100 basis points closer to it right now. There are many estimates of where that might be, and we know we're a lot closer to it, and I think we're in a good place, but I think from here, it's a new phase, and we're going to be, cautious about further cuts.
But I think that the markets are looking for a little more clarity. I mean, I've heard estimates from 2.9% to 4%. I think the markets would like to see a little more clarity about a year out, 18 months out, as to where that goalpost, for lack of a better term, is. Because at the moment, it looks big.
Yeah, I mean, honestly, there are countless models of what a neutral rate might be at any given time. There are empirical models, there are theoretical models, there are things that combine them, and they have as many different answers as you'd like. So there is no real certainty. And I mean, it's actually a good thing to know that we don't know exactly where it is. So you're not tempted to think, oh, I think this model or this estimate is right. You just have to be open to the empirical data that are coming in, and also how it's affecting the outlook. And it's not made any easier by the fact that that our policy works with long and variable lags. Nonetheless, that is the job we have, and so I think it's appropriate for us now to proceed cautiously, now that we're 100 basis points closer to neutral, and we'll do so. Meanwhile, the economy seems to be in good shape, and these cuts will certainly help to support economic activity and the labor market, while we can still make progress on inflation because policy is still meaningfully restrictive.
Victoria.
No, you got to end the press conference. You have to end it.
Victoria Guida with Politico.
Our gold trade's struggling
I
here.
understood what you were saying at the beginning about inflation.
It's
Are
gone
you saying
way
that
too long, about 3 or 4
progress on core
questions too
PCE
long at this point.
Counts as progress on inflation.
This is done for a reason,
even
I'm
if
telling you.
Headline inflation ticks up, and then
Look at,
also
our charts don't
since that's
lie.
what's
Bang.
projected in the SEP, I was wondering.
Traders
what
want him to
accounts
stop
for that?
talking so they can
Why
buy
do
the
you all
market.
see core PCE going down and potentially headline inflation ticking up?
So, and as I imagine the goal overall is headline inflation.
Yeah, you're
because
right,
that's
Wizard.
what people
Double bottom
experience.
here.
People don't experience core inflation; they experience inflation, and that includes food and energy costs. So that's the overall goal. But as we know, headline inflation contains energy and food, and those prices can fluctuate for reasons that are not related to tightness in the economy, and therefore are not really good predictors of future inflation. So it turns out that core inflation is a better predictor of overall inflation than overall inflation is. So we look at core inflation because it's a better measure of what future inflation is like to be, because,
we don't even have a W
because it's a
set
better
up yet.
measure of what inflation pressures exist. So it's complicated, but ultimately our goal is headline,
complicated.
not core. So
Try
your second question was what?
Why do you all see core going down, but headline potentially taking
Pretty
up?
good stuff right there.
So
on Bitcoin.
headline can be affected. You're talking about next year.
Mm-hmm.
Yeah, so headline it can be affected by energy prices and food prices. So that there will be things in the headline forecast that are to do with forecasts of energy prices, whereas core will be, if you look at core going out a full year, then it'll be much more driven by things like tightness in the economy. So
We're getting
that's
compressed here.
why the two can go in different directions. Headline has been lower, as you know, most of
I would
this year.
bet that we
That's because
probably are
energy
gonna
prices
check out
have been coming
2600,
down, which is
That's
a
what it
great
looks
thing
like
for
to me.
people. But energy prices will come down, and then they will go up, and it won't
There's
really
bidders.
be telling us
There's
anything about
bidders,
how tight
but-
the economy is and how future inflation will perform.
Right there was our
Do
trade.
geopolitical
Bang,
risks
bang.
factor in at all to how you're thinking about energy
So
prices?
we monitor geopolitical risks really quickly, but really carefully.
Remember,
rather.
these are
But,
demo dollars.
I would say so far those risks haven't really. Nothing has come out of those risks.
we go.
Has really
You
been
talked
important
about
for the
5
United
minutes
States
too long,
economy.
killed
the
us.
single thing that you would look to is the price of oil, given that we're talking about the Middle East and Ukraine, but that is a good summary statistic for the kind of thing that could go wrong with global turmoil. But the price of oil has been coming down, and because of supply conditions, global supply
How do you
conditions.
figure that?
The U.S. is not feeling really the effects of geopolitical turmoil, but we are certainly at a time of elevated geopolitical turmoil, and it remains a risk.
Kelly.
Thanks, Chair Powell. Kelly O'Grady from CBS News. I want to go back to something that you said a minute ago, that
Holy
wage
cow.
growth is outpacing inflation now. It wasn't the case for some time, of course.
Yeah, Calvin,
and
right now they're
partly
driving
why
the dollar.
Americans haven't
This
felt
press
much
conference is
relief
about
in their
5
wallets from
questions too
prices
long.
yet.
They usually run
But
about
with
35
inflation
minutes.
ticking up,
We're going
how
on
worried
50.
are you the progress in closing that gap could go
This
away?
is being done on purpose.
Yeah, So inflation, again, we don't overreact to a couple of months of higher readings or a couple of months of lower readings. And what we had was we had 4 months of really nice readings, and then September and October were higher, but then November is much lower. So I don't really think the public is experiencing that as a surprising upside risk to inflation. I think inflation is much lower. What the public is feeling, and they're right about it, is that prices are just, the price level went up because of the past inflation, and it's going to take some time for real wages to recover over a period of years in which your real compensation is growing. And in other words, your compensation is growing meaningfully faster than inflation. That's exactly the kind of economy we have now, and we just want to hold on to it. That process will probably take some years, but that's what's going on right now. And I don't think that a couple of months of higher inflation really signal that anything of the nature you're suggesting.
And just one follow-up. Let's look more long-term. You previously predicted hitting the 2% inflation target in 2026. It's now been pushed out to 2027. You said you're focused on enabling further progress on inflation. That's not necessarily progress in the right direction.
That's a good one, Daniel.
Are you confident that target isn't going to move further out?
We're talking about when you're projecting the economy, 3 years out, 2 years out, you're talking about high uncertainty. Very high uncertainty. We really, at that point, it's not possible to confidently predict where the economy is going to be in 3 years. So what we're doing is we're looking at what's happening now, and we're kind of projecting that
the
same
buyback
kinds of things are happening. So we keep a strong labor market.
Nope, it's the trend.
Housing services inflation comes down, goods inflation settles down, and non-market services return to their prior level.
Yeah, it's a good
All of
point,
those
Calvin.
things should
They're just
happen
cratering
over
this.
time. And,
Is this
and,
the
those
beginning of the
pieces come
buyback,
together.
though?
There's
That's
every
what I
reason
want to
think
know.
that they will. The timing of it is highly uncertain. But you're not
It's
wrong.
coming
though,
here sometime.
that,
Let's go ahead and get out of that.
It's been a bit frustrating because while we've made progress, it has been slower than we had hoped. Nonetheless, we're still on track. And
here it
I
is.
think if two years ago you'd said we were at 4.2% unemployment and 2.8% inflation.
Traders are getting ready for him to shut up.
Would say, I'll
That's
take
why
that.
they're going long.
That's a pretty good interim place to be.
Stop
Job's
talking,
not
pal.
done.
That's enough. You've done enough.
But I think we're
You have
feeling
done
good
enough.
about where we are and where we're headed.
Killed our gold trade.
Nancy for the last question.
There's one more question. Are you kidding me?
Hi, Chair Powell, Nancy Marshall.
Well, we're gonna
Genser
take
from
it.
Marketplace. You said a couple times inflation
There's
is
the
sideways.
Crossover, prices
appears to be
above
settling
this.
in around,
Who knows what
excuse me,
happens with him still babbling.
2.5%. Do you think the Fed is just going to have to settle for that and accept?
Yeah, I think you're right, Calvin. We're going to take a shot on this strategy right here.
No, we're not going to settle for that. I think we certainly have every intention and expectations that we'll get inflation back sustainably to 2%. That
right
is,
beneath this swing
and I
low.
am confident we will
We're
achieve
basically
that.
betting the things. We're betting that it's in.
Longer, but it's
so wherever you want to put your profit target.
We are making progress.
Shoot up
We
here.
have made a great deal of progress, and we'll continue to do so, and get back to 2%
38
inflation.
minutes
That's
left.
what we owe the public, and we're committed to achieving it.
In that case, can you rule out a rate hike next year?
Don't say it.
You don't rule things completely in or
God.
out in this world.
Don't you say?
That
Why would
doesn't
you ask
appear to
that
be
last?
a likely outcome. I think we're at 4.3%. That's meaningfully restrictive, and I think it's a well-calibrated rate for us to continue to make progress on inflation while keeping a strong labor market. So, thank you very much.
Holy cow. Well, very rarely do I get combative about trading. That press conference went about 10 minutes too long, and you can see exactly what happened right in here. We really did. I mean, we thought that, okay, he can't say anything else to kill us, and then look what happened. You still went along the ride for about another 4 questions. This is as high risk as trading gets. Trading during these press conferences and Fed releases. So if you're not doing well, or if you don't understand what's going on, or maybe you got on the right side of the markets, good for you. Personally, made one trade earlier today. We did it on the 10-minute scalping blitz earlier today and missed another one, but we made one. Fed days, I've had some of my worst days on. They can be really tough. You're either right or you're wrong. And right here, it looks to me like we're going to get eaten up on this 1-minute chart. What we're trying to do is we're really trying to catch the bottom of this thing and have price give us a positive close, because it's really difficult to say that we're not oversold right now. These losses, okay, quarter-point rate cut should have sent the markets higher, but it was a hawkish rate cut. If you've never seen one, you just saw one today. And there's a couple of things that we need to look at here before we sign off. I'm going to let that go. As far as our gold trade, I have really no doubts that we're going to come back here, but I got to tell you, this is ugly. This didn't need to be this bad at all. You could easily, that's one of the reasons why I tick scalp. You get right in here, you get a nice shot right off your entry point, and you rally up. I mean, right there probably would have been our entry, somewhere down in there. Our low was 209.54. That was our entry, and then you got the spike up there to 13. So you got about $3.50 on that trade. That's a pretty good scalp. That's really what I like to do. Typically, once these levels give way, they don't do very well. You usually see the trend continue, but for right this minute, we're going to stick with it, because I think the guy talking absolutely was what was killing price action. And I don't know that, I can't prove that it was on purpose that the press conference went 12 minutes longer than it should have. But yeah, I just don't believe in coincidences, guys. I've heard of them. I'm not a conspiracy theorist, but I don't believe in coincidences. So there you go. Right there, there's your sweep lower. This is going to get knocked out almost assuredly. So you just got your stop loss right there, and we're just getting eaten alive right now. That's just the way it is. If you haven't traded today, you did the right thing more than likely. If you got on the right side of price action, great. But, like Calvin's been pointing out the entire time, what you have here is a dollar index that is just absolutely on a tear today. Look at the daily. That's it. That's all there is to it. That tells us everything that we need to know about the markets. So wait for this dust to clear. If you're serious about trading and you're trading your real money or you're trading your prop account or something, wait for this dust to clear. There's going to be some great trades to be had tomorrow. I don't know that we rebound tomorrow. I really don't. Nobody knows the future, but I do think you're going to see a pullback at some point, and more than likely that's going to start in the next, I would say, after the U.S. close. I expect positive price action to begin developing during the overnight and in the futures markets. But yeah, that Kurd Mayran, that is what a dirty FOMC. That right there, yeah, I got a million things to say about it, but there's really no point. I will take issue with a couple of comments that Jay Powell, because the numbers just don't back it up. He starts talking about crude oil. He was talking about crude oil pricing. Well, that's sort of our wheelhouse here. This was the EIA report from earlier today. U.S. commercial crude oil inventories decreased by 0.9 million barrels from the previous week. At 421 million, we are 6% below the 5-year average. The 5-year average is what? It's a big deal this time of year, because we're in wintertime seasonality. We're pricing lesser demand in our prices. He says that prices have come down, and that's just categorically false. We're at $70 going into Christmas, and we're running 6% beneath the 5-year average. That's a disaster scenario. That's something that the next administration is going to have to deal with. And I would look out. I would be careful with my crude oil price projections through the first half of next year. I really would. The other thing that I would point out, these 30-year mortgage interest rates, these came in before the market today, 6.75 and negative 0.7. That stuff right there, we're going back over 7% just based on what he said today. It will not shock me if by the end of the year we're at 7.25, and that's really going to hurt home buyers. Really going to hurt them. As far as our expectations here, I do want to say the DXY continues to, look at this thing, continues to just slaughter it. But realistically, our Fed watch, January, what are we waiting for? 90% chance that rates are held firm. How about in March? Okay, we're talking 4 months down the road, 3.5 months down the road. Still pricing about a 55% chance. If we're going to cut rates in 2025, when's it going to be? May? I think you're going to see the pullback, a major equities market pullback before that happens. I can definitely see that happening, guys. So be careful. Be careful if you're holding big investments this next year. But definitely for us traders, it's going to be absolutely fantastic. All right, tonight, were you shorting the NAS? No, I wasn't shorting anything. We had a bounce. This was our trade idea. You can see right here, okay, we're already swept out of the box. That was a dreadful. That's why you have to have stop losses trading something like a 1 minute. You go right here, US 100. Let's go right here to our US. And this right here, You got to get out now. We're getting flushed. You can wait for this a minute, but I mean, realistically, this was a nice scalp, but right now we're just correcting. The big thing that I would point out, seriously, I got to get my charts up. The big thing I would point out here, this is gold getting absolutely smoked. You've got to already be out of this thing already. I mean, I'll pull the plug on it right now. It's just a terrible, terrible situation. We were in pretty good shape right there, and then we just kept bleeding and bleeding and bleeding, and it's a trend. Now where do we go? Well, what happened to silver? We warned you about silver. Be very careful here. Get out. Get out now. Get out now. This is potentially a real ugly situation for silver holders. The next bid you want down there is about 28.30. Look out. Look out. This was a big correction day. This is one of the reasons why I mean, if you're going to trade Fed days, I highly recommend managing your risk and not getting cute. That's for sure. Arshad, your opinion, please, for tomorrow. Yeah, a couple of things I want to point out here. This was let's get back to the US 100 chart here. I do want to point this out. I expect retracements. Here was our US 100. Here was our bullish trend. Right there was our buy. We weren't getting married to it by any stretch of the imagination. What we wanted was to get a nice bounce, and we really didn't get much of one. We got a little bit of compression on a 5-minute chart. You've got to be out somewhere up here. You cannot still be holding. We got a nice really bounce off of 78%. 62% didn't mean anything. Why didn't those levels mean a thing? Because of the Fed, because of what happened today with Jerome Powell. As far as tomorrow goes, I would be looking for a rebound. I really would, but you've got to really watch your trade locations. I'm not interested at all in buying silver. That ain't happening. Also, gold. Let's take a look at gold while we're at it. Gold right here. You probably have a reason to buy gold right around 25.76. You could probably get away with something like that if you wanted to get in at 78%, and that's not a monthly retracement level. It's a weekly. So something like this could definitely get you in. But remember, it's not that great. The market structure is not that great. But that bid right there from 25.76-ish, that's probably going to be a pretty good area where you could step up and do a little bit of business in the gold market to the long side. So that would be one level I'm looking at. And just as far as the rest of it goes, US 30, we scalp some US 30s. This thing is gone. I mean, it's gone. So what we have to do is we have to make a couple of different decisions. Number one, what is our duration? This is a weekly chart. It's going to be 3 negative weeks in a row. I think that this price action is really indicative of, number one, geopolitical fears, but number two, what we see coming from monetary policy and what the story is going to be. The story is going to be Jay Powell and Trump fighting, and they're going to fight openly and in public. Jay Powell won't say much. Trump will say it all. And it's what I saw today was a very combative Fed and somebody that was sending a message. And the message was, we're going to do whatever we want in your markets. I mean, the guy straight up asked Powell about the markets. He said, hey, listen, our markets need more clarity. Will you give more clarity? And the answer was, well, there's a million different ways we can interpret things. That was a ridiculous answer. It was almost a disrespectful answer. That's what I don't like. I think there's an attitude in that FOMC boardroom. And I don't care if you're a Democrat or Republican. I don't care. We're traders. Our goal is the same, is to make money. You got to make damn sure that we understand that the Fed, if in fact they keep rates high, that it's not a vendetta thing. We got to make sure of that, and I got to tell you that it looks to me like it is. Painted a very rosy picture of the economy and inflation, and that's not the case. I think we're in trouble here. I think these markets are in big trouble. I would almost point towards a bearish year for 2025. I really would. Right there, the 42.5s, that's going to be a pretty good bid for you tomorrow if you get there in the US 30. As far as the US 100 goes, is there any peace? Is there any hope? Well, the bullish trend's definitely getting challenged right now, but I always fall back to my long-term numbers when I see a major move like this. I highly doubt we get down to 22.50 or anywhere down in here. Let's back this up to a weekly and see if we can get after it here. 38%'s gone on the weekly. I don't buy 50s. 21,000 would be a pretty good bid for you. So if you're interested in the US 100 tomorrow, that 21,000-ish is going to be a pretty good bid. All right, guys, I'm going to go ahead and sign off for now. One last thing we'll look at, gold getting smoked right now at 25.94. Just get out of the way. Get short or get out of the way. For me, I wouldn't get short right now because I think all the good trade locations are gone. As far as Bitcoin goes, big time zone. This area right here has been a lot of business conducted, but if we wanted to tighten this up just a little bit, take a look at where even more if you're an order block trader. A lot of business right in there. 101 to 100 is a big deal. And if we trade down from there, you'll probably catch some bidders down there at 94. We'll have a trade ID out later today. I'm going to wait for the dust to settle here. But all in all, challenging session. Remember, we showed first and foremost what risk is. And when you take risks during a Fed announcements or during a combative Jay Powell where things start happening and you don't understand what's going on, get out of the way. Don't try to fight the markets. Just get out of the way. Right now, we're down 689 on the Dow and cratering. Bitcoin's coming off. Gold's coming off. How bad is the damage on silver? That's going to get really ugly for silver holders. It really is. So there you go. Okay, everybody, I'm going to go ahead and sign off. Bitcoin to 70. Nah, I doubt it. 100 probably be my bottom. But we're going to look at the charts and we're going to do a little bit of work. Thanks for joining me, everybody, today. Tomorrow's session is going to be interesting. Remember, if you're trading yen, BOJ, the BOJ is active. The BOE is active. Expect more fireworks, and you're going to definitely want to make sure that you watch your risk. A very delicate time to be in the markets. I think we're going to have a great day of trading tomorrow. After that, I'm looking for liquidity to start drying up. But make no mistake, what happened today was nothing short of the Fed drawing a line in the sand with the new administration. And, a lot of people is going to say that I'm crazy, and that's not true. It's 100% true. That's exactly what happened today. That presser went 15 minutes too long. Every time Jay Powell said something, he was throwing gas on the sell-off. And right now you're at 715. You're down 715. You're down 642 in the NASDAQ, 3%. Be very, very, very careful if you're trying to buy these things. I highly recommend waiting. Till tomorrow. All right, everybody. That's it. Fantastic. A lot of fun. I want to say you guys trade the action well. We're going to be back here tomorrow and be looking for trade ideas and things. We'll have something out later today. But I'm going to let the dust clear from this just A-bomb that Powell dropped on the markets. All right, everybody. Have a fantastic day. Trade the action well, and we'll talk soon. See ya.